If we go back in time, even a decade or two, a new expansion record was set in the world's financial markets, more precisely, a decade after the worst of the global financial crisis. Compared to other decades, the stock market has performed very well in the last few years. The S&P 500 index has more than doubled in value since then, while the price of a single stock has increased more than threefold. This unprecedented expansion has been made possible in large parts by historically low interest rates. Recall that the highest interest rate during this period was just 2.5%. As a result, expanding companies could get the funding they needed at a lower cost and with less effort in 2019. Stock prices were rising, opening up profit opportunities. By the end of 2019, many people believed you can buy anything. The rapid doubling burst the bubble, but it was a global problem this time, and the unprecedented 10-year run finally ended. In today's video, you'll see why Warren Buffett thinks this is a once-in-a-lifetime opportunity for you to buy everything cheaper in 2023. And stay till the end to learn the best-kept secret that can help you win big. The end of the road? As investors lost hope in the market, they began to withdraw their funds. As the epidemic spread, there was unrest in all parts of the world. A number of companies failed, and the stock market and other financial markets collapsed as a result. Many people lost a lot of money during the recession. Governments around the world, faced with the high cost of the epidemic, directed their central banks to create money to cover these expenses. Similarly, the Federal Reserve produced billions of dollars and sent them into the economy in the form of stimulus checks, bailout packages, etc. Still, this free money was ultimately not enough to save the American people. As a result, the economy expanded, leading to the highest inflation rate in the United States in 40 years. Last June. High inflation has persisted in the United States for decades and has caused previously affordable goods and services to become increasingly unaffordable. Many well-known companies are struggling at the moment. In addition to the real estate market, the stock market is also in a slump. Many traders have been dumping their stock holdings in anticipation that the global economy would soon enter a catastrophic recession. In that case, should they enter the market when it is at its peak or when it is in a downturn? Time to buy. It is common knowledge among investors that collapses offer the best opportunities for profit, and that these collapses often take time to occur. No one can guarantee with absolute certainty that people will never live again in a time when everything is cheapened. This may not be the right time to get rich, but it may be. Find out if now is the ideal time and how to take advantage of it if so. There are many people who would be better off without stocks because they are easily upset by fluctuations in the cost of living. You should not make hasty decisions just because your stock price is falling. Because of the mental nature of investing, you should avoid doing so. Success in investing depends on spotting bargains and profiting from rising prices. However, in reality, no one trades this way. Instead, they trade on a buy high, sell low basis. Frankly, they do not want to do any damage this way. When circumstances are difficult, investors pull their money out of the market because they are afraid of the future. However, many well-known investors such as Warren Buffett, Charlie Munger, and many others argue that a bear market is the perfect time to buy. A long-term road. Most people invest in the past because they lack a clear vision for the future. They rarely prepare for long-term savings or investments. And so, when things go wrong and a recession hits, they flee the short-term disaster rather than seize the opportunity. That's not a wise course of action. That's why we tend to accumulate stock holdings rather than liquidate them. Most people save money, so they should want the stock market to fall so that they're well off. But people are weird, and they do not. Although rational decision-making dictates that individuals should buy when prices are low, instead, they prefer to wait until the stock has increased in value. Let us look back at the bull and bear market that the United States has experienced since 1926. Since 1926, the United States has had 11 bear markets and 15 recessions. By the time of the pandemic crisis in 2020, there would be 12 bear markets. In total, 14.7 years were spent in bear markets, while bull markets lasted 75.4 years. The reality, however, is that those who invested in the stock market during these turbulent times fared quite well. For example, after the Great Depression, investors made a 265% profit in just 4.4 years. After that, people earned 43% in 1.8 years, 210% in 4.1 years, and 901% in 14.8 years. And this upward trend continues. Investors who have endured some of the worst market downturns in modern history, They have been able to achieve annual returns between 20 and 50%. However, you should know that there is no such thing as a risk-free investment. These trends show that bear markets are excellent buying opportunities. For example, you could have gained a lot of money in 2020 if you had bought at the peak just before the outbreak. You would have earned a 9% return on your investment. The stock market bottomed out a few weeks ago, and if you had invested at that time, you would be sitting on a tidy profit right now. After the peak, your returns would have increased by 60%. That's why it's important to have an entry point. But keep in mind that significant declines of this magnitude are unusual. One study found that bear markets last an average of 14.7 years, while bull markets last an average of 75.4 years. Investments should be made during economic downturns, but how can you maximize this opportunity without wasting it? Be on the lookout for openings. Always pay attention to current market conditions. This way, you will take advantage of all the opportunities that come your way. The second step is to ensure the effective execution of your approach. You should take precautionary measures at the first sign that the market is falling. There are known to be two main types of long-term investments. In the long term, you should either use dollar cost averaging or value investing like Warren Buffett. People often prefer to pay for things over a long period of time. As introduction to dollar cost averaging for the uninitiated, if you want to allocate your money to the stock market, you need to buy index funds, such as the largest index fund in the world, the S&P 500 Index Fund. You choose to invest the same amount in a mutual fund that follows a market-neutral strategy. Your money is invested across the entire market. For example, in the amount of $2,000 every 6 months. The long-term goal for this approach is to achieve a 10% annual return, which is equal to the performance of the S&P 500 index. This tactic may not seem like an attempt to time the market or profit from a falling market, but that is exactly what you are doing. For example, on October 9, 2007, you spent $2,000 to buy 12.78 shares of SPY. The next year, when the market fell, you paid $2,000 for 20.5 shares, for a total of $2,000. It's simple. When the price of the stock is low, you buy more of it, and when it's high, you buy less. In a sense, you are right. This is the most effective strategy for passive investors to take advantage of. Active investing. In contrast, active investors like Warren Buffett like to pick and choose the stocks they put in their portfolio. They are convinced of their superiority over the competition, high profit margins, and smart management teams. We will not go into that strategy here. However, we will explore how proactive investors avoid costly mistakes in a volatile market. It is essential that we first explore the situation. Inflation and interest rate hikes are among the biggest challenges facing companies worldwide. As a result, consumers will be less willing to spend money, and lenders will demand higher interest rates to borrow. But now the question is, how do we determine whether a company will come through this unscathed? Discretion in pricing is essential for any business. In other words, it is in a competitive position. It can safely raise prices without scaring away buyers. For example, many companies have lowered their prices on consumer products because customers are spending less on those products. However, companies like Coke are so robust that they do not have to lose sales even if their prices go up to account for inflation. They can simply charge their customers higher prices. Another factor is the rising cost of borrowing due to rising interest rates. So to ensure the success of your business, consider the following. Debt is something you should keep to a minimum. Take Google, for example. In this case, the company's cash on hand is higher than its debt. With a debt-to-equity ratio of 0.5, cash flow is positive. If Meta does not owe anyone anything, it's at its best. Choose a strategy for your company. Make a deep research. Peter Lynch claims that it is harder to exit if you have no financial obligations to the company. The last thing you should do is examine the business model. How do you want to run your business? How well do you think it can weather the storm of a bad economy? For example, grocery stores often see higher business during economic downturns. The reason for this is that people cannot help but buy the necessities. Companies that specialize in arranging insurance, airline tickets, boarding passes, and so on. In other words, people just cannot help themselves. This means that committed shareholders should keep an eye on companies' pricing strategies and debt levels. On the other hand, passive investors are more concerned with the long term. What type of investor are you? Tell us in the comments. Leave a like and subscribe for more videos like this one. And if you like this video, you'll definitely learn from the next one.